mode.
Well, hello everyone, and welcome to Arizona Investor's Arizona Market Update. I am Travis Cabin, one of the founders of Arizona Investor, and I cannot tell you how impressed I am that you all have taken time out of your day to get educated or updated on what is actually happening and what we feel is one of the strongest real estate markets in North America. And to help describe what's going on in the Phoenix market, we have a very special guest joining us today. And we're just going to be introducing him here just in a second. And this individual presents the market data like no other. And I can tell you we've researched that market high and low, and we're proud to have a strong relationship with this individual. Today's webinar is going to take approximately 60 minutes to go through, so I thank you for your patience going through it. We're going to go through market data so we can provide you an update as to what's happening in the real estate market. So it's not necessarily the most exciting topic to talk about, but it's probably the most important thing to talk about so that you fully understand what is going on in a market where you have maybe already invested or you're thinking about investing in this market. And again, thanks for joining us. If you would like to ask us a question, feel free to do so, and you can type that question to us in the chat box that's located in the bottom right-hand corner of your icon screen. So if you just go to your screen there, and even if you want to test it, you can just put your cursor over the chat column there, and you can just send us hello, and you can just test it just to make sure that it works. So through the course of the webinar, if you'd like to ask any questions of us, feel free to do so. And because of the timing of this presentation, we're not going to be able to answer questions live through this process. But what we're going to do is we're going to make sure we get back to you with the answers to your questions right after they come in. So again, feel free to leave us a message or a question if you feel that if you'd like to do that. As most of you know, we are an education-first company, and we call it Education for Effective Action. And keeping with that tradition, we provide constant market updates in areas where we have been actively buying properties with our investors. And we feel it's important to do a number of things, and those things are such as know your market. Whether you're an existing investor or you're thinking of investing, know your market before you do anything. Where is it now, and can you see clues as to where that market may be going? Sometimes when you look at the data, you can draw some conclusions, but you need the accurate and proper data in order to see where that market may be going. What asset classes provide the best opportunity? Is it land? Is it construction? Is it single-family homes? If it is it a buy and hold strategy, or is it a buy, rental, and flip strategy? If it's multifamily, same thing. Is it a buy and hold strategy, or is it maybe a buy, rental, and flip strategy? So what asset classes are we looking at? Is the market in a growth phase or a retraction phase? Is it a cash flow market or an appreciation market, or maybe a combination of both? These are all very important things. And of course, it is a supply versus demand market, and what are the fundamentals that are driving that market? And so hopefully we can draw some insight into that as we go through this presentation. Our special guest today is Mr. Alan Langston. He's going to help us understand and deliver the messages to what's kind of going on in this market. Alan, how are you today, sir?
I'm doing great, Travis. Thanks for having me on and giving me an opportunity to talk about our market here in Greater Phoenix.
You know, Alan, you do a great job of explaining what's going on in the market, and you deliver that data on a monthly basis. And I know you do it more on a monthly basis, but you do it with your organization, AZREA, which is the Arizona Real Estate Investors Association, and of course, ARPALA, which is an organization you founded to bring the owners and landlords together. Alan, can you briefly describe what you do with AZREA?
Yes, I'll be glad to. It's actually an organization that I founded back in 2002, and it was to bring together the real estate and investment community here in the Greater Phoenix area. We since have expanded it to Tucson and to northern Arizona as well. Mm-hmm. And we believe that it's fundamental for investors in real estate to be able to make informed decisions, to make proper decisions in their investments. They need to have information to do so. So one of the key things that the association brings to its members every month is what we call a market update. And we have 2,000 or so members of the organization, and many of them use this data to at least give them what they believe is a competitive advantage in the marketplace to understand the trends what is happening, because if you can determine trends, you may be able to determine what's going to happen next. And so if you can at least identify what's going to happen next earlier than most, then that certainly gives you a competitive advantage. And that's what we try to bring to our members. We've been doing this market update, I think, now for 6 or 7 years. We do it every single month.
And I can tell you firsthand, Alan, after obviously being a member of ASREA, and also Arpolo as well, but after being a member of ASREA for the last number of years, I truly do appreciate the value that you bring to our organization. And, you know, we look at other markets and we extract data from other markets, but there's no market in North America that we participate in or have participated in the past that provides the data that you do. And you do it in a way, Alan, that the average investor can understand it. Sometimes that data can get pretty thick, and after you read chart after chart after chart, it kind of gets muddled in, and then eventually you throw in the towel and say, geez, it's too confusing for me, I don't get it, you know.
And another important thing for everyone to really understand is we don't have a horse in the race, right? We're not investing with our members. We're just providing them data to make them more effective and more profitable investors. Naturally, I'm a real estate investor myself. I have my own investments, right? And real estate's an excellent place to be. And understanding the market, you know, just makes people better at what they do.
Totally. Yeah, I couldn't agree more, Alan. And we're proud to have you on the call today to deliver the message. So why don't we start digging into it? We'll go through some slides, Alan, and I think through the course of this presentation, what we'd like to get across for our listeners is we'll talk about, you know, what's happening with the supply side, what's coming through the trustee notices. We'll talk a little bit about that. We'll talk a little bit about where are home loan delinquencies at. Are they maybe been increasing? Are they neutral and flat? Or are they maybe home loan delinquencies decreasing? And so we'll take a look at the supply side of things and look at those numbers. Let's take a look at pricing to see where are prices at, where were they, and maybe we can draw some conclusions in our own mind as to where we think they may be going. Is new home construction coming back in the valley? The very interesting thing, we always knew it would because the population growth is so strong in that market year over year. It typically is, unless you're in recessionary times. But that's a very interesting thing, and I think there's some interesting dynamics going on there. And is it still a good time to buy properties for investment in the state of Arizona, specifically in the Maricopa County area, which encompasses Phoenix and the other cities that are there? We'll talk a little bit about InvestR's blue chip properties, and we'll maybe show you some of the things that we're doing down there to take advantage of this market. So we've got a number of things we're going to go through today. But we're going to start off right at the top. And Alan, maybe just give us a bit of insight as to what's happening with the notices of trustee sales by month. And maybe tell us, what does it mean, notices of trustee sale? What is that, Alan?
Sure. I'm actually going to back up just a little bit ahead of that. What investors need to understand is that there's multiple ways to source property or to acquire property.
Sure.
Over the last few years, one of the areas that has been most effective, because you can acquire property at actually, I believe, in most cases, the lowest rate, is if you buy a property that is being foreclosed on. And so you buy it from the trustee sale or at auction. So in Arizona, Arizona is a trustee deed state, not a judicial state. Okay. So the foreclosure process ends up at an auction, and you actually are buying, you're buying the property, getting control of the property from the trustee, from the lender, okay, through their representative, which is the trustee. So you're buying these at auction. That completes the foreclosure process and the transfer of ownership to the person that purchased it as auction. So what this chart reflects is it goes back basically 6 years, and it shows the increase in the number of properties actually being bought at foreclosure auction. At the trustee sale, therefore, we know we had this bubble in the real estate and people couldn't afford their homes anymore in the foreclosure process, and this shows it peaking in the first quarter of 2009. And, that's a long time ago, okay? Being that we're now in the third quarter of 2012. Yeah. And so this chart just depicts that it has been that window of opportunity from a supply perspective of buying property at the auction has been slowly closing for over 3 years now. And we're down to 3,292 when this chart was put together just a few days ago at the beginning of September. And while we're not back to a normal range, we certainly have come down a long way, and the market is very quickly kind of recovering.
Sure. So obviously trustee sales is a conduit of product for the savvy investor, but the actual retail investor, I think they'd have a hard time as an individual showing up and thinking they're going to be able to buy a property off the trustee sales.
Oh yeah, we actually suggest to our members that, not to do that, to work with somebody that has the skill base to be effective there, just because of how the sale works and the properties that come on and get delayed or get canceled and back and forth, and really understanding the value of those propities and be sure you're bidding the amount that's appropriate for the property that you have the interest in, right? I see way too many people overpay at auction because they don't understand what to do.
We see that every day, especially now that we're starting to see a little bit of an uptick in the market. We see investors that are actually overpaying the market. They get caught up in that frenzy. They don't know the pricing to the zip codes because there's different pricing to different zip codes in the Valley of Phoenix. And we see that now. Of course, Arizona Investor is an active participant every day bidding at the trustee sales because we have a full team that's dedicated to analyzing the list, analyzing the cost, analyzing the actual value of that property, doing the inspection to find out, is the home worthy of purchase? What is the rent-ready work that needs to be done? What's the rental demand for that home in that market? So that's what we go through, but we definitely don't recommend that a retail investor show up there and think they're going to start to buy there because it probably wouldn't be a wise investment for them, and the chance of success isn't as high. Let's flip on to the next slide here and see what this tells us.
Yeah, here again is another chart on the notice of trustee sales by month. It just draws the attention that this is the lowest number that we have seen since September of 2007, which goes back a long 5 years now. So again, the number, the quantity, the volume available through trustee sales coming down does not mean, however, that there are not great deals to be had at the trustee sale. They are. They are still probably the best deals will be had at the trustee sale. You just really have to be very competent at what you're doing to buy the right things now.
For sure. So what we see here is we see that the amount of trustee homes that are going to auction, we see that the number is down from where it was, but we're not at a normalized level yet to call it a normal market. Alan, what do you think the bank's take on this is when they see that, obviously there's a shrinking supply, there's increasing demand, you've got the hedge funds that showed up in the Phoenix marketplace and in January of this year. What do you think about the bank's awareness of this current rising market value? Do you think that they're adjusting their opening bid price of these houses?
There's no question that they are, and of course different banks, different lenders are responding to our changes in our market differently. Probably the best example of change would be Bank of America, which basically does not want their properties now to be sold at trustee sale. Okay, they will price them in a way where they won't be sold because they want to take them back. Because they believe they will get more for the property through the REO process, which is real estate owned, so the bank reselling the property, they'll get more for the property there. And fact is they will, right? Normally, if you just look at how things are, from a historical perspective of the numbers, they will get more there. So that will mean fewer properties will be going for sale at the trustee sale. More will be going through the REO process for Bank of America. Other lenders, we haven't really seen much of a change, so it all depends on how the lender operates.
Sure it does, but there's definitely that upward pressure on prices. I think we're still below the normalized trend line, but there's still that upward pressure on prices, and we always knew this was going to happen. And let's take a look at more the longer-term past horizon as far as where we've been, Alan. This kind of depicts a pretty good picture as far as where were we and where are we today.
It does, and again, it makes that point. We're kind of rapidly getting back to a normal level of trustee sales. There's always trustee sales. There's always foreclosures in a market. There's always deals to be had at the trustee sale. That will never change. This basically says we're not back to normal yet. There's still a lot of opportunity to buy at the trustee sale. That opportunity is less than it was a couple of years ago, but it's still there. Okay,
sounds good. Let's take a look at the percent home loans delinquent but not in foreclosure in the state of Arizona. This is a pretty interesting slide, Alan.
It is a very interesting slide. Now, people in different companies look at delinquent rates a little bit different. Some will look at, 30 days late. Others will look at serious delinquent being 90 days late. Mm-hmm. It doesn't matter what you are looking at. It all is showing a tremendous recovery from the highs in Arizona, now down much, much lower. So 30 days late is one piece of information. Here you can see we're down from 12.4% 2.5 years ago, down to just under 6% now.
Sure.
So an improvement of over 50%, down 52%, which is a very, very good thing. Why that is good is because we're seeing fewer and fewer delinquencies. Our market is moving towards normalcy. So what does that mean for an investor? Right, Travis? That's kind of the
that's kind of what it comes down to. Absolutely.
Yeah, that's the real question. Well, what it means is supply is getting tighter for distressed properties. Okay, yeah. So that is going to have an impact in price, and we've been seeing that, and that's going to continue to take place. It means there's still opportunity because foreclosures are not down to normal, so it's still a very good time for investors to buy. But the reason they buy might be different. Okay, you will see margins getting skinnier if you are buying an investment property to rehab it and resell it. Okay, commonly called a fix and flip. Right.
Sure.
Those margins will be getting squeezed. Mm-hmm. On the other hand, the rental market is very, very strong and continues to be. We see that market continuing to expand, and we are seeing rental rates continue to increase on a very acceptable level, a sustainable level.
Sure.
So that market's very, very strong. So this chart says things are getting better. Arizona is actually improving much faster than the rest of the country relative to its delinquent loans, much faster. We will be probably in the top tier of states as far as that recovery goes. My prediction would be if it's not in September, it'll probably be in October, at least on the serious delinquent mortgages. So we'll start being looked at in the healthy states, like Texas and North Dakota and South Dakota and places like that.
Sure.
So it's all that is good news. Okay, it is all good news. This is happening, but it still says there's opportunity right now.
It does.
To buy distressed property.
Yeah, it shows that the market is improving, that the amount of people going through foreclosure is diminishing, but we're not there yet. So what does it mean for investors? It means that there's still opportunity to participate in a cash flow market, because typically Arizona in the past has been an appreciating market, but with the downturn of the market, it became a cash flow market, but also we're going to get back into appreciation again, we believe. So you're going to get kind of the benefits of both angles here, from both the cash-on-cash perspective as well as an appreciation perspective. Yeah,
we're already seeing the appreciation, annual year-over-year appreciation. We've had that for several months.
Sure.
So that again is a very positive sign. Candidly, the appreciation's been going up faster than we would like to see. And we will see that slow down a little bit, but it still will remain, we believe, at healthy rates.
Sure. You bet. We used to be ranked 35th in Arizona, and it looks like we've improved, Alan.
Well, we were the 5th worst, and now we're the 35th, so we're in the top half of the state, so to speak. The interesting thing on this chart, as you can see, is Arizona was certainly worse than the rest of the country, right? And we have now improved to be much better than the rest of the country. And there's some reasons to that. We don't have to get into all the details, but that's the purpose of this slide, is to say Arizona is recovering. We're recovering faster than the rest of the country. It's a strong recovery when you look at that in relation to, where were we in relation to all of the U.S. as a whole to where we are now. Phenomenal recovery. And I think that's one of the, obviously, the fundamental drivers that are there, and there's lots of factors to speak to why the recovery is so quick. But it's pretty phenomenal when you look at it this way, to see how we were the 5th worst ranked state in the country, and now we're 35th. So it's pretty impressive to see that turnaround and how quickly that took place. When we look back to June of 2009, and we kind of look at the hot spots, where there was the most amount of the subprime mortgages consumed, and I think the most amount of defaults in mortgages. Tell us a little bit about kind of where that market was, and when we look at all of the U.S. now. Yes, you look at this, and so you can see visually, very quickly, the states that are in good shape and the states back in 2009 that were in bad shape, very bad shape.
Right.
And so you look at areas like Florida and Nevada and, of course, Arizona, was right there kind of, I believe, right in third place, maybe fourth place, but, right in that range right there that, as far as first loans, right, not being current, so 30 days or more delinquent, 14% is a very, very high, very, very high number.
It's a big number.
Big number. And you can see the areas of the country, that were kind of in normal ranges. A 4 to 5% range is going to be normal. Okay.
Yeah. Totally.
And so I think the next chart will show kind of where it is, in summer of 2012. Yeah.
Sure.
And you see we're already down in that 8.8% range. This is a different source, because different sources track it differently. But more importantly, you can see Florida got worse.
Mm-hmm.
Okay.
And isn't that something? It's pretty amazing when you see that.
Yeah, it is. And of course, there's certain areas of the country, or let me rephrase that, there's certain states in the country that will recover slower. And the reason that they will recover slower is how they treat their inventory of distressed properties. There's judicial versus non-judicial states, and this is getting very, very technical. But the trustee states, like we mentioned at the start of this presentation, like Arizona, are recovering much faster than the judicial states like Florida.
Yeah,
okay, like New York.
And that's because you can actually purge the houses through your system so much quicker. And in a trustee state such as Arizona, 90 days delinquent on your mortgage, and you're heading to the trustee steps.
Right.
For your house to be sold on the 91st day, your house can be sold. It can happen that quick, and a lot of Canadians are shocked when they hear that because they're going, "Holy smokes! Here in Canada, it takes 6 months to a year for it to go through the process, and down there, 3 months." And that 91st day, it's going to the trustee steps, and so that's what we call a trustee state, say, versus a judicial state such as Florida, where it would take longer to go through the system.
Exactly, and it's going to take those judicial states years longer to recover on the real estate side than the trustee states, and that's just, that's very, very unfortunate that that's the case, because that's going to affect the entire country.
It totally is. It's just going to drag out the process very much. Alan, prices have they've increased from the trough. Now, we've got to remember that we were in such an overcorrected market that were prices going to increase at some time in the future? We always knew they would, because we were at such an overcorrected state, strong historical population growth market Arizona is, specifically the Phoenix Valley. So we knew the prices were going to appreciate from where they were, but they rose fairly fast from October 2011 to, say, May 2012.
Yes, they did, and there were kind of reasons for that. I did many, many presentations over the years and months, and our prices stayed low artificially. There was no reason for them to be that low for as long as they stayed that low, because our volume, the velocity of our market was very strong, very high, yet prices were not responding to the velocity in the market. Right. And so we had this period of time where they should have been going up and they weren't. So it's like a spring effect, right? That spring kept getting tighter and tighter, and finally everybody, the market realized, wait a minute, these prices, need to be adjusted. And so this period of time just kind of hit in the late fall last year, and prices started rising very, very rapidly, and this held true through May. Now, the rate of price increases was unsustainable. Yeah. Right. It was actually at a rate higher than what we saw back in the boom years of 2006 and so. Okay. Sure. So we knew they would slow down, and they did, and we're very thankful that they have slowed down after May. It doesn't mean our prices aren't going to continue to go up, and that's an important thing. When we talk about supply here in a few minutes, we can probably have that discussion. Yeah, exactly. So the prices were going up faster than the values that appraisers or institutions would put on the houses, because they couldn't keep up with that level of change. But even though they rose very rapidly over that 6, 7, 8 month period of time, it really should have been spread out over a longer period of time. It just didn't start when it should have started. Exactly. There was catch up that was happening during that period of time.
And the appraisals on these properties is about a 90-day drag on these values. So here you've got a rising market, prices are going up on a monthly basis, but when an appraisal is based on comparable sales, from the past, well, you're going to have problems where your appraisals don't meet the purchase price, because the purchase price will say this is what the house is worth today, but the appraisal is going to be a trailing data compilation of previous sales, and so there's problems with appraisals in the marketplace. And so the reality is that's it. And if people want to close on some deals, typically what they're having to do is pay more than what the house would actually appraise for, so they're having to put in some extra cash.
Exactly. Investors need to be prepared, to do that. I mean, appraisals, when prices are going up, appraisals, lag, and when prices are going down, appraisals lag on the high side, right?
You're right. Yeah.
Because prices are always moving one way or the other, and the appraisal system is not a very good system. It's worked for a long, long time. It just doesn't respond to the market fast enough. So an investor just has to be prepared to act based on what they know is happening. Yeah. Not what processes that lenders and government agencies have tell them it's happening, because they're usually delayed.
Yeah, so it takes some adjustments. If you want to participate in the market, you just have to be adjusted to play based on the market conditions the way they are today. So very interesting. This is an interesting chart here too.
It is, because this chart actually shows what has happened, and of course you can see $190 a foot was where it was back at the peak. Right? It's going to be and people need to just wipe the peak out of their mind. I'm always reading articles in the paper about prices are this far below the peak and how long. Forget the peak. For an investor, the peak has no meaning. It has no value. Okay. Yeah. So you have to forget that, because it's just not true, right? It doesn't matter. But this chart, of course, we got down to just under $80 a foot. There's the $79 a foot back last fall. Okay. Now, the end of this chart where you see the little downturn, right? That peak right there before the downturn, that's the May period of time. And prices were going up, as you can see. That rate, from the October period last year to May is much too steep of an incline. So you've seen a pullback, a little bit from the May time frame. Now, prices never go up in a linear straight line fashion. They always move, okay? They're always going up or down a little bit, down a little bit, up a little bit. So what are the overall trends? The overall trend is for long-term price appreciation. Okay. Right. Short term. Okay. It was to see that we knew there was going to be some short-term downturn in price. So investors have to realize, if anybody tells you they can predict price, they are definitely high on something, because they can't do it. Okay. But what you can predict is what's going to happen in the next 30 days or so, because you can look at what's closed and what's in the pipeline. And what it was, so you can look at those and say, okay, here's what's going to happen in the next 30 days. That's why we knew prices were going to turn down. Well, guess what? Indications are now that prices are going to turn back up slightly, okay, based on the same type of thing over the next 30 days. Now, this chart here, this is one of the most important charts. I show this chart, or a version of this chart, all the time. Here is the message in this chart. Back at the beginning of the last decade, we were right around $100 a foot, okay? And we know that prices over time generally go up for all those reasons, their cost of raw materials, right, so forth, and cost of paying employees and that type of stuff, and construction workers. All that goes up over time, and that affects the price of a home, right? Yeah, absolutely. So long term, you can see, if you just use a very conservative compound annual growth rate, for the price of a home, this would tell you the price should be somewhere around, 130. Actually, I calculated at about $134 a foot. That would be where we should be with just a conservative annual compounded growth rate. Okay. This chart, would show that we're right about in the high 90s. Okay. So for just simplicity's sake, let's say we've gone up a little bit the last few days, and we're at about $100 a foot, kind of where we were back at the beginning of 2001. This tells you that there's over $30 a foot in price improvements, appreciation still to come, using very conservative numbers. So the question becomes, when are we going to get there? It's going to take us a while to get there. But that is basically a 30+%, 33%, undervaluation currently in the market, and this varies widely by price range. This is the overall market, and it's actually in the lower price ranges more dramatic than it is in the upper price ranges, right? To give a quick example, if it's under a $100,000 house, those prices are still well below where they were at the beginning of the last decade. So they actually have almost an 80% increase that could be available to them relative to the similar type of conservative growth rate if it's applied.
Sure.
So as investors, and you know this, Travis, because you are, things are changing in this market. You have to drill down deeper and deeper into the numbers to make informed decisions to increase, your odds of success.
Sure.
Not only your odds of it, but how much profit you can make.
Yeah.
So that's what is increasingly important, is to really understand the market. As our market improves, you really have to get better at analyzing the market and making sure the deal and the house that you're going to buy is going to provide the best returns for you.
Totally. So what it tells us here is it tells us that it's still an undervalued market in relation to where it should be from the normalized trend line. And when you look at the long-term trend, or we sometimes refer to that as a normalized trend line as far as where prices should be, it kind of goes back to where's supply, where's demand, but where is replacement cost? Because in a growth market, things are always going to pull up to that replacement cost normalized trend line. And we can see just based on this graph, we're far below where it should be. Even though prices have come up, we're still below where we should be. Let's dig into the supply side a little bit. Let's take a look at what's happening on the supply side. Where are these properties transacting, and what's the breakdown on that?
Yeah, let's look at the overall market first, because there's a story here that people need to understand,
Sure.
because it gets you to understand where the market is headed. So you can see here back in March of 2011, we had 39,000 listings in our MLS system, the multiple listing service here in the greater Phoenix area. You can see most of those, okay, a little under 16,000, right, 15,000 or so were normal listing. That's an owner-to-owner sale, somebody that lives in it and wants to sell it to somebody else to live in it. You can see, the number there that was short sale, and you can see that number had come down, since just, March of 2011. So that blue area got smaller, right? Yeah. And then the red area, which is the REO, you can see that got significantly smaller, right, in a very, very short period of time to where we are. The HUD, the Housing and Urban Development homes, it's minuscule relative to this market. So if you go to the next slide, we're going to contrast that, and we're going to look at it in price ranges. And so here you can see a single-family home below $75,000, and you take out any home that has a contingent contract on it. So AWC stands for active with contingencies. So there is an offer on the home. The offer has been accepted, but there's contingencies in those to that home closing. Well, you can see over the same period of time that, especially when you take out the AWCs or the active with contingencies, you can look at that blue area. That's the short sales. Then you can see how dramatically that has come down in terms of an actual available supply.
It's amazing the reduction we've seen in a short period of time. If you look at, say, you've got a year and a half, the reduction of the amount of listings that are out there, and especially on that short sale side.
Yeah, it's just incredible. So you go from 3.1 months of supply to a 6/10 of a month of supply. So that is that basically says there's no supply. Well, of course there is. Most of the supply here in this price range is certainly on an owner trying to sell to another owner, and the higher percentage to that is still on the REO side, or property the lender has already taken back at auction.
So what you've seen is the market shift from basically kind of a seller market to more of a buyer type of market when you see these types of things, from a buyer market to a seller market in these types of situations.
Yes, you have, and so you're starting to see, and whenever it is a seller's market and not a buyer's market, what does that mean to price?
They're going north.
They're going to go north, right? And that's why when I'm talking to our members and doing this very similar type of presentation, I am telling them that long term, all indications are is that prices are going to continue to go up.
Totally. You betcha.
And that is why. So it's a supply and demand equation. It's simple. Now this chart looks at the 75,000 to 150,000, also takes out homes that have an active contract with contingencies on them. And it's the same basic story, okay? So you're seeing, just a couple thousand homes, right, that are available in this price range. Okay? And so it's come down dramatically. It's in a year and a half, just dramatically.
It's amazing how that's pulling to a normal transaction where you have a normal seller and a normal buyer. Neither one's under distress. Sure, maybe the seller might have not made as much money as if he sold in the peak, but it's a normal transaction. It's not a foreclosure. It's not a short sale. It's not an REO. It's a normal transaction. It's going back that way.
Yeah, actually now, where I believe we're at 56% of our market, that is a normal sale, an owner-to-owner transaction.
Yeah, we haven't seen that in some time.
Ooh, yes, for a very, very long time. We've actually been north of 50% for the last few months now.
Yeah.
That is a tremendous, crossing that 50% line is a tremendous indicator that our market is recovering. And what this means is that means, you get that health back into the market. It is much more predictable. And as investors, it's important to have predictability.
Who's on the buyer side of things? Like we understand that that the supply is shrinking, and we're kind of going, from a we're kind of shifting into a seller type of market in a lot of cases, depending on the price range you're looking at. But who are the buyers, Alan? Is it the investor buying it, or is it the local Arizonian coming in and buying their own principal residence?
Well, obviously, it's a combination. Okay, with 56% of our market being owner to owner, a lot of that, some of that will be an investor that bought a house, rehabbed it, and is selling it at retail. That's an owner to owner sale. But the far majority of that, is somebody that now finally, believes that they can sell their house for closer to what either they paid for it or actually have some appreciation in it, right? Sure. So it starts freeing up that inventory, which is a good thing because that has impact. Take an investor that's going to buy a house now, right, in this market today. Now, we just went through the pricing charts that says overall in the market, right, around $100,000, there's still 30+% of appreciation just to get back to where it should be.
Sure.
Okay? Now, each deal is different, right? Not all deals do that. Some will have more than that. Some will have less. You have to be an educated, informed investor, right? So there's all the disclaimers. But overall, in general, there's a 30+% increase in price that has to happen at some point just to get back to a normal rate.
Agreed.
And get even back to a replacement cost rate.
No, it's true. That's totally true.
Okay. So you have that. So if you're buying a home now as an investor, you have that proposed built-in appreciation, right?
Right.
So that part is key. Now, supply is lower, right, which indicates that, okay, I'm going to be able to probably recognize that increase in value quicker, okay? Right, because supply is lower, so you're going to see those prices continue to go up.
You're going to see that upward pressure on prices, right?
Upward pressure on prices, but at the same time, I'm going to hold it.
Yeah.
Okay? I'm going to hold it as a rental for multiple years. So my odds of seeing that price increase and seeing that appreciation is much improved over if I had to sell it in 6 months.
Mm-hmm. I agree.
Make sense?
Oh yeah, totally. It only makes sense when you've got the supply that's diminishing and you have increasing demand. It's going to put upward pressure on your prices. Not to mention you are still at an undervalued market and magnified in certain price brackets.
Right. Exactly. Certain price brackets. It gives you a different. The information's just different, right?
It is.
And so you look at it, you go, okay, as an investor, here's what I have to do in this price range. And we would, I could tell you an X price range, you still got this gap relative to how much money you're going to make on a normal rehab, right?
Right, exactly.
But on rental, in this price range, you got to be really, really careful, on a normal rehab. You can get to that level. And, of course, area of town and neighborhood, all that means.
All those things, right? Absolutely.
Yeah, I mean, the little things, the details is where you really make the money on this. And we're talking a little bit globally. But then you factor all of this in for most investors that are buying long-term. You didn't factor in the rental market to this and what's happening in the rental market and the demand on the rental side, because that's what has to work for you for the next few years until you decide you may want to turn the property.
Exactly. And as we see the average price of the single-family home, and we look at these price brackets, we simply see more inventory. But what we see also is a common denominator that is going back to a normal seller-buyer market. Sure, as you increase in price, there's not as many buyers, and maybe there's not as much product being consumed by buyers. So you see an increase in the amount of inventory that's available. But as an investor, we're not buying a house for $250,000 to $500,000. That's not the market where a typical investor for a buy and hold strategy is participating, simply because you get better cash-on-cash returns typically in a house under $200,000.
Correct. That's absolutely correct. And you can see here, yeah, in this price range, there's a little bit more supply. There's 2.3 months, but that's way under normal. An aggressive market would have 4 months of supply, right?
Agreed.
A normal market closer to 6 months of supply. So under 3 months, and so we're seeing the prices increase, in the higher price ranges, as well. But that's not a normal. Yeah. For most investors, they're not going to risk doing rentals in that high of a price.
I agree.
Range. This is kind of cool. Yeah, this is pretty neat. So here's a house that was listed for sale in Glendale, and if you know the Valley of Phoenix, it's on the west side, and if you don't, I'll tell you, it's on the west side, and it's in the Valley of Phoenix. It's in Glendale. It's a good area. It's more of a blue-collar type of neighborhood. It's also home to the Phoenix Coyotes and the Arizona Cardinals Stadium. But there's lots of good, strong employers in the area. It's got a fantastic transportation network around it. We own a number of properties in the city of Glendale. And so here's a house that was listed for sale on April 14th for $119,900. Now, our investors typically don't buy off the MLS because we get better deals and better product by going through Arizona Investor and obviously us buying our properties through the trustee sales, because every house that goes through foreclosure goes through the trustee process. So here's a house that was it was an REO put on the MLS at $119,900 on April 14th. The house actually closed on May 11th for $140,000, but here's what happened to get it to $140,000. You may look at that and go, well, geez, it was listed for $119,900. How did it close for $140,000? Here's what happened: because of the, again, shrinking supply, strong demand, and a lot of retail buyers out there. When I talk about a retail buyer, this was bought by an owner-occupier. So this house received 95 offers, 51 from investors, 44 from owner-occupiers, 38 offers were all cash, 28 were conventional, which means it didn't require the high ratio insurance, very similar to what you'd have here in Canada, CMHC insurance. 29 offers were FHA or VA, which is an insurance underwriter, allowing the lower down payment owner-occupiers to get into to home ownership. And so how amazing is that? Here's a house that was listed for $119,900, and they actually took it under contract for $140,000. Tons of attention on this house, and are we still seeing this go on, Alan, in the marketplace? Maybe not to this magnitude, but are we still seeing this type of frenzy go on there for the retail buyers? Yes, it's interesting. So that's created other dynamics in the market. Certainly, this could be considered a little bit of an unusual case. 95 offers on a single home, right? But it does tell you what the demand is in our market. And not only that, but the demand is coming from multiple points of interest, not just investors. Right?
Exactly. Totally.
And so that's a healthy sign, right? Because the interest in our market has not waned. For the last 2.5, 3 years now. Our velocity is high, demand is high. High demand is almost usually a very, very good thing.
It is,
and it is in this case as well. So so it shows those things about our market. It's very descriptive of our market, but then it changes behavior. Sure. Okay, the behavior it starts to change is where will regular folks buy homes, or how, and the same thing is true with investors. Okay, how does that change people's behavior relative to this situation being in the market? Sure. And it does. And okay, there's a slide. That's perfect. New homes is one of those places where it will change behavior. A buyer, will say, okay, I can't get an existing home and I can't get a distressed property because they're going for people that have cash, or they're being bid up on the prices, or whatever the reasons, right? They have their reasons. And so, with those reasons, okay, people say, well, maybe, hey, what about new homes? And that's what has transpired. We are seeing now demand come in for new homes. Builders, our permits are up. My gosh, on the new home side, permits are probably up close to 70, 80%.
Phenomenal.
Okay.
Yeah,
phenomenal,
crazy.
Right? And so the new home builders are, quote unquote, kind of back in business right now.
You bet.
They're seeing growth. We need to see this because building of new homes means jobs. right, and lots of them. The issue here will be, do we have the people to fill the jobs? Right? Do we have the lots that are ready to be built on and so forth? So we're seeing, we are now seeing issues with that side of the market, but they're all good, positive issues to have because they're good for our long-term stability and growth.
So prices have gone up over the last 12 months, and they've been kind of climbing over the last 24 months, but they've really kind of escalated over the last 12 months, really since January of 2012. So what's happened is prices have kind of got to the point where for certain builders in certain price brackets, they've been able to get back in the marketplace and actually build a home and sell it in relatively close proximity to where a used house of similar vintage would be sold in that neighborhood. They can actually make $1 or at least keep their lights on. So we always knew new construction was going to come back. It's now starting to come back. And what's happened is the builders that are active in the kind of the starter range or the investor type range, they've actually been able to buy lots, service lots, that have been foreclosed on by the lender, and they've been got a substantial discount on those lots. Now, those lots were either serviced or they weren't serviced. So they were able to buy those lots at a discount, put in an affordable house, and provide a house to an investor or an owner-occupier, in most cases an owner-occupier. But now what's happening is those lots that they bought that were distressed, that they got a steep discount on, guess what's happening? They're all getting consumed and houses put on there. And now what are they doing? They're looking to build new lots. And what happens when they're building new lots? They're paying current prices. And so it's going to put an upward pressure again on the new home prices over the course of the next 12 months.
You're absolutely correct. Absolutely
and that's
correct.
exactly what's going on in the market.
Yeah,
yeah,
it is. And of course, normal buyers, when they go buy a new home, they're able to finance. They get financing. They don't have to have all cash. You know, and all cash dominates a lot of the distressed side of the marketplace right now.
Oh, yeah. No, absolutely. So it's good to see that new construction come back, but it's kind of coming back in a phased-in price point plan because they're able to get some discounts on those lots. So interesting to see. And this is a pretty interesting slide here where you see where the base list price is of a new home. So you can see where it was at the start back in, well, if you go back to March of 08, you can kind of see where the price was of a single-family home, a new home, and see where it bottomed out to if you could actually get a builder to build you a house at that price, if they would actually do that, and then kind of see where things are going now from a price point as to where we are in our market now.
Yeah, notice that long extended period of prices being basically level, and the corresponding increase in price in this neighborhood that you're looking at corresponds almost exactly to when we saw the prices really escalating on the existing home side.
It's true. Yeah, no, it's totally true. So, and I think some of the builders there were actually building houses just to keep their lights on and keep staff, even though they might not have been making money building those houses. They did it just to keep their staff employed. Sure, they might have had to cut back staff, so instead of having 100 project managers, they went down to maybe 10 or 20 or whatever it was. But it was basically just in a survival mode just to keep their lights on.
Sure, no question. They were doing that, and of course they were also went into the home rehab business rather than the new home business.
It's true, yeah, just to keep things going right. So, you know, one of the reasons why we like Arizona so much is historically it's always been a growth market. And as a real estate investor, we like growth markets because it's always going to keep the upward pressure on appreciation. And sure, you can see your 7 or 10-year cycles. You just got to watch that bubble effect or the formation of a bubble. But Arizona being a growth market and also having positive, not only population growth but also job growth as well, really favors investment. And construction's always been a driving force behind the economy in Phoenix. And here you can kind of see where the population increases has been in the entire state for the last few years, where they were through the kind of the recessionary times, and where the economists feel that the population growth is going to be in the years to come. So again, we really like to look at this slide as a real estate investor because where there's population growth, what does it mean there's going to be? There's going to be construction. Why do real estate investors like construction? Because there's always going to be the pressure on upward appreciation in the prices.
Yes, and the other reasons we like the population increases is that, one, it confirms Arizona as a growth state, but two, all those people that are coming have one thing in common. they have to live somewhere.
They do. Yeah.
Right? So
Absolutely.
this bodes very, very well, not only for new construction, but for rental as well, and rental pricing as well.
Absolutely.
And there are a lot of things we're seeing that confirm this, that this will actually take place, because these are projections. They come from Arizona State University, so a very reliable source. But confirmation of a lot of people and businesses believing this, we see it in our building permit process on the large multifamily construction.
Yeah,
they're planning
absolutely.
for this increase. And when you start looking at 120, 130, thousand new residents a year in Arizona,
Phenomenal.
you basically divide that by about 2.3 per unit. Okay.
Yeah. No, absolutely.
You get the housing units you need, whether it's a new home or a rental property or a apartment or whatever, and it's a huge number.
Yeah, there's lots of
year after year after year.
There's just a ton of good positive attributes to having a growing market or investing in a growing market, and one of them, of course, is the upward pressure on appreciation. And so, of course, with population growth, why are people coming there? And Arizona, by the way, has an average age of about, Alan, what is it, about 38 years old?
Yeah, somewhere in there. It is amazing. People think we're an old state and only retirees come here.
Canadians sure do because of all the snowbirds going down there, for sure. Absolutely, but it's not that way, though.
Yeah, most of the people here, it's not that way. Most of the people moving here are younger people. I think the average age of the people moving here is in the low 30s, right?
Yeah, totally.
It's an amazing thing, and we know most of those people, most of them will not buy a home right away. They will rent. Right, which really helps our rental market, even more. So it's
exactly.
It's amazing. Arizona has the long reputation for the age of our state.
It does. So here's a pretty interesting stat. This is total non-farm job growth by state, and so you can kind of see where Arizona ranks in for job growth out of all the major MSAs in the U.S. And you can see that Arizona right now is ranked 6th for their job growth, and it's increased 2.31% from August 2011 to August 2012. And so pretty impressive ranking when you see that type of growth for job growth, because as investors we like that because it means we've got people moving there and getting jobs that are actually making money.
Exactly. We don't see this changing. We actually project that we will continue to get better even than ranked number 6, right?
Sure.
It's, historically what we're doing, and this is across all the job categories. This is not like in one, like in manufacturing or something.
Sure.
Our communities here, Arizona supports all the different subcategories of job growth in a major way. So this is reflective of jobs in healthcare. This is reflective of jobs in construction and jobs in manufacturing. Jobs in government. So
exactly.
It's broad-based. It's broad-based, I guess, is my message.
It sure is. But again, as a real estate investor, we love this data, and we like to see, and we like to invest in markets where, again, not only do you have population growth, but you also have job growth. And you can see that we have that coming back to the state of Arizona. It's a great thing. And so that's kind of our analytical approach in the statistical data to kind of give a snapshot as far as where that market has been and maybe give an indication on where it's going, and you can draw some conclusions from some of the data and the analysis that we're looking at. And investing in real property is always a wise course of action so long as it's based on strong technicals and fundamentals. I just wouldn't recommend that and say that investing in real estate is always a wise course of action no matter where you put your money. It's very important that you're looking at the fundamentals and the technicals of the market that you're looking to place your capital. Now, as Canadians investors, which a lot of our investors are, and it's tough for us to find the investment opportunities in Canada like we can find right now in the U.S. and in the undervalued U.S. real estate market. But not all of the U.S. is a great place to invest. You've got to look at the individual markets to see where the greatest opportunity is. That's why our team has been very active in the Arizona market, buying undervalued properties since 2009. And so I remember buying properties when people are saying, you're crazy buying properties in Phoenix, Arizona. Do you not know there's a recession going on there right now? Do you not know that prices are in the tank? And I don't know if they're ever going to come back. When in reality, we're buying properties for $35 to $50 a square foot, including the house, the land, the landscaping, the kitchen counters, the toilets, the sinks, the whole 9 yards, everything done for that price, phenomenal, and we can rent it out, and our vacancy rate has never exceeded 5%. So were we seeing positive cash-on-cash return? Absolutely. So what we've done is we've designed an entire turnkey system to allow Canadians to participate in the undervalued U.S. market and provided an opportunity for Americans to participate in the Arizona market in a turnkey system. So not only do we provide the market research and analysis, very similar to what we're doing here today with our market update, but also full property selections, where we're able to acquire the properties from trustee sales, very, very specific properties hand-picked in very specific zip codes, do the renovation on them, get a tenant in place, and provide you a cash flow property from day one. Of course, that all comes with a cross-border tax consultation, making sure you know how to hold your title based on what your investment objectives are, and also getting you in contact with some of our U.S. and Canadian mortgage lenders as well. And just to take the myth away, yes, you can get financing in the U.S. being a Canadian, and we have that with the Arizona system. And so it's our full turnkey system. We walk the investors all the way through the process and make sure that they have a good investment property that's hand-selected, tenant in place, and make sure that they have an easy system to make sure they can file their taxes on an annual basis and enjoy the rewards that can be achieved through real estate ownership. Now, of course, we have been fairly active in the single-family home area, and yeah, we've taken down a few condominiums as well over the years on very specific projects, because with condos you have to be very specific as far as where you buy your project or where you buy your condo and which project you buy it in to make sure you can achieve your objectives. Here's an example of a property that we had available for our investors, and this is a property in Avondale, again very close to Glendale on the west side. Its current price is $124,900. The peak price on this home was $227,000. This is like a standard house for our Arizona investors. So you can see it's not a dumpy little house with bars in the windows and the shingles are in rough shape, and you can see it's a decent home, and you can see that it's got 3 bedrooms, 2 bathrooms, 1,390 square feet, 2-car front attached garage, and this house rents out for $895 a month. Was built in 2004. You can get into this house for $43,715 as your total down payment. The balance of the money is coming via one of our U.S. lenders. And now you would have to qualify for that loan, but we have a process that we can walk you through to assist you to get qualified for the loan package for this house. Now, with your anticipated appreciation over the next 5 years, your total ROI would be 17.62%. So that includes your cash flow, your principal paid down on your mortgage, and a modest appreciation factor at 4% per year starting today. And even though you heard Alan talk about, we could see up to 80% appreciation in some factors of the pricing scale, depending on where they're at, or maybe 30% if you're looking at a house in the $100,000 range. We just took it back and said, let's just use an average appreciation factor of 4%. So we feel that number is fairly conservative. Here's another property, again in Glendale, $159,900. Peak price on this one was $227,000. Again, it's a 3-bedroom, 2-bath, 2-car front attached garage. The rental income on this one is a little bit more at $995 a month, but it was built in 1992, so it's a little bit of an older property for us to fit into our portfolio, but it's got the right age, it's got the right size, cash flows from day one, and actually the tenant in this home is the previous family that owned the home, and they actually owned it for 14 and a half years, and they would like to buy back this home from our investor in about 3 years' time. So there's a little tidbit of for an investor looking to get in and get out and get paid. Here's somebody who wants to buy that property back from you at the value that it is in 3 years. Now, condominiums, we're pretty selective on where we invest in our condominium investors. Here's a great project in Central Phoenix, built in 2004, 1,700 square feet. It's a 3-bedroom, 1-bath, $895 a month, and the purchase price at $99,900, 6.2% cash-on-cash return, unlevered. This project has a pool. It's got a great room. It's got a workout facility, movie theater, fantastic location, and highly desirable area. Tenant in place, cash flows from day one. Also, we didn't talk about apartments much on this presentation, but there is some joint venture opportunities that are available right now for investors who would like to joint venture on maybe some bigger projects with us. Instead of buying maybe a single-family house, maybe you want to participate as a joint venture partner in a multifamily building. Those offerings are made available through a private placement memorandum, and it's made available to accredited investors both in Canada and the U.S. So if you're interested in that, feel free to get in touch with us at the number you see on the screen. Alan Langston, I want to thank you for joining us today.
I'm very happy to do it. Thanks for having me on.
You know, we value what you bring to not only Arizona Investor, but what you bring to our investors, and you've been a big supporter of ours for a lot of years, and the data that you provide to us is just phenomenal. And the other thing is it's current data, Alan, and it's hot off the press. So thank you for joining us, giving us a market update, and we look forward to seeing you next time we're down there.
Very good. Thank you.
Thank you all very much. And for everybody who's on the line today, again, thank you very much for being on the line, participating. If we can help you out at all, please feel free to call us at 1-855-456-3223 or info@arizonainvestor.com. On behalf of myself and all of us at Arizona Investor, thank you very much for taking your time to get educated for effective action, and we look forward to connecting with you real soon. Thanks very much, everybody. Take care.